Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I'm speaking to Steve Bennett, CEO of the direct property business within Charter Hall. We will discuss the key trends, risks and opportunities shaping Australia's commercial real estate market. Welcome, Steve.
Thanks, Anna.
So how is Australia's population growth translating into demand across commercial real estate, and what segments are benefiting most?
Why don't I start with an area that people are more familiar with? So residential.
Yep.
There's been a lot of media speculation and talk around the population growth and what it's meant for availability of rental stock, and how hard it is for that supply to keep up with that population growth. What people don't realise, that exact same thematic is having a similar impact on the office market, industrial and logistics, and retail. So you've got challenges in meeting that population growth. You've got all the same hurdles that the residential does, but because it is real estate in the commercial space, it's not necessarily as well understood.
So what are the key barriers to new commercial property development, and how do these supply constraints shape investment opportunities?
Yeah, put simply, a lot of supply simply doesn't add up for a developer. And if a developer or a builder is going to make a loss, what are they going to do? They're not going to build it. And the challenges that pretty much cut across all the sectors: adequate skilled labour, cost of land, delays in DA approvals and planning approvals. These are all things that add to costs of construction. And in most of the core real estate sectors, and let's just take office for a moment, replacement costs, so the costs it would take to build this property here or the one out the window, is around 50% more than what it costs to buy an existing de-risked asset on the market. And so what it means, the rational decision is the supply is not coming out of the ground quick enough to match that higher demand. And we don't think that's going to change until either building costs fall, which they rarely do, but much more likely you're going to see higher rental growth come through the markets. And as long as that rental growth keeps coming, you will eventually hit a point where it makes sense commercially to build a new office tower or industrial property or a neighbourhood shopping centre.
So Charter Hall has long been a major player in convenience retail. How do you define this sector, and how does it differ from discretionary retail?
Yeah, look, we have around $16 billion of convenience retail. The way I like to explain it, and the team does at Charter Hall, is think of your most defensive retail assets. So your Coles or Woolworths anchored neighbourhood shopping centre, your net lease retail, so think of a Bunnings asset. And we love this stuff because not only is it often in metropolitan locations, on main arterial roads, big land holdings with lots of parking, it's almost impossible, and some areas completely irreplaceable, to have competition come into that catchment. And if you look at our portfolio, in our most recent fund, our Coles and Woolworths are trading about 20% above the usual turnover for a Woolworths or Coles. So usual turnover is around 45 million per annum. We're 20% plus higher. And what that means is you get greater growth out of the asset. So not only are these assets super defensive, but you are getting that growth that will come through over time.
Can you explain what discretionary retail is for people who don't know?
Discretionary are things that move up and down depending on the economic cycle. So think of your electronics, your jewellers, your fashion. The non-discretionary, think of your food, a lot of the specialty tenants that hang off those neighbourhood shopping centres, fuel retailing, and Bunnings, which is very defensive as well.
Steve, rather than competing with online retail, convenience assets are said to complement it, which I find really interesting. How do you see that relationship evolving as shopping patterns change?
Yeah, look, I'll talk about it in relation to that convenience retail, that non-discretionary retail. So it is a common misconception that online is going to kill all that. Well, in fact, 80% of the online orders from your big supermarkets are fulfilled out of the neighbourhood shops. So they're convenient, it minimises the time to the end customer, and it's also complemented by things such as click and collect, that direct boot to service for the client as well. So it's not an either or, and we also in the industrial space, for example, have a lot of their big distribution centres for Coles, Woolworths, where that serves a different part of the market. We do think that what is not as well understood is the way that population is moving. So not only are these centres really convenient, and we think we'll have great growth, but that population growth I mentioned earlier, that tends to be highly concentrated in areas around train stations with great transport links. So it means if you're a landowner or an investor that already own those super defensive neighbourhood style retail centres or a Bunnings, they're basically irreplaceable. And they're going to capture a lot of that upside growth versus, say, a new shopping centre going into a greenfield residential development, which will typically take 4 or 5 years before it even gets close to that turnover rent thresholds.
Yeah, I mean, you can see those shopping centres, like they're just the main artery of the community, which is interesting.
People pop into them multiple times a week.
Yeah.
So we work busy jobs, still got to feed the family. You might pop in on the way home, pick up some milk, pick up a roast chicken. That's why it serves that everyday needs. And that's why we like it. It's the kind of real estate that trades well, people continue to go to regardless of the economic cycle.
Okay, so you've mentioned the quality of tenant covenants as a key strength in this sector. Can you explain that in more detail?
Yeah, so if you're managing big portfolios of real estate, and Charter Hall is the largest owner of real estate in Australia, one of the things you want to make sure is that you've built defensive cash flows, because ultimately it's the tenants that pay the rent who you then ultimately distribute through to your end investors. So you don't want tenants that go broke, you don't want any challenges. And we've just been through one of the fastest periods of interest rate increases over the last few years. And across our platform, we had almost no defaults. And that's not an accident. It's because we consciously target those government tenants, ASX top 50, big private enterprises that have fortress balance sheets, that have great cash flows. So the real estate, yes, it needs to be well located, it needs to be high quality, but ultimately it's that security of cash flows that our investors value. And we've got a lot of financial advisors, wealth groups, family offices, and one of the things they put a high premium on is that regular income paid either monthly or quarterly through to their clients.
Okay, so Charter Hall recently achieved MSCI index inclusion for the Convenience Retail Fund. How does that milestone fit into your broader real estate strategy, and what does it signal about institutional appetite for this sector?
Yeah, let's start with the end bit first then. What it signals is a rotation of where the largest super funds, pension funds, sovereign wealth funds in the world are trying to deploy into the retail sector. So if you look back historically, they tended to buy those huge malls. Think of your Chadstones, your Bondi Junctions, those very large dollar value malls that tend to have a big concentration of that discretionary tenants that I talked about earlier. What's changing is they're looking at an opportunity in a highly fragmented part of the market, those neighbourhood shopping centres, the Bunnings, where they haven't traditionally played, but for all the reasons I talked about around that defensive characteristics, they're now redeploying into this part of the retail sector. So that inclusion in the MSCI benchmark is really a reflection of where the most sophisticated, largest investors in the country, and also the money that comes offshore, are now deploying into that retail part of the market.
How are you currently positioning across the key commercial sectors, and where are you seeing the strongest relative value today?
Oh, that's a tough one. I've got 3 kids and there's 3 core real estate sectors, and I won't give you a favourite. What I will highlight is where they're at in the cycle. I'd argue convenience retail's come out of it the strongest. Industrial logistics continues to perform very strongly. We've got around 5 of the lowest 10 vacancy markets globally in industrial and logistics here in Australia. And the office sector is very interesting. It was very, very taboo for a number of years. What we're seeing now, particularly some of that offshore capital, the larger institutions, are very much considering markets such as Sydney CBD, where we are, Brisbane, even up in the valley, because they're seeing a price disconnect. Office values have reset so hard that on a relative basis, you can pull out some fantastic distribution yields and also total returns from core office assets that you'd normally have to take major repositioning or development risk to achieve.
Equally, where are you being most cautious right now, and what are the key risks that you're actively managing across the portfolio?
Yeah, the way I explain commercial real estate in the country, and I try and get people to think about it as they would a stock market portfolio. Not all stocks on the ASX are equal. There's higher quality, there's less quality, there's some that have high growth opportunities but no cash flow. There's blue chips with great cash flow but limited growth. In commercial real estate, you really need to pick your underlying sector and market. We believe in providing that highest quality opportunity to investors, and we let them pick the sector. So yes, my team and myself are very heavily involved in unlisted property, but also A-REITs are another way you can access it. So I don't think there's anything to be particularly concerned with at the moment from a valuation point of view. We've had a tough time with valuations peaking in June 22, but we're now on the other side of that property cycle. And the thing I would avoid is thinking you're getting a bargain by buying lower quality, off-pitch location stock. There's a reason it's probably priced like that. And I would say because we are coming out of this bottom of the cycle pricing, you don't need to move down the quality curve to get great returns. And in fact, this is a bit of a unique period. Markets have reset in some sectors harder than they did in the GFC. So those investors that come in now are likely to get outsized returns simply because of where we are at in that valuation.
Okay, so finally looking ahead, where do you see the next phase of opportunity in Australian commercial real estate, and are there any particular structural trends that investors should be paying attention to?
I would say the opportunity is now. I've been a lot more cautious the last few years. What we wanted to see was those interest rates begin to come down, which they have, and whether they settle at this level or not, it doesn't matter. They've already come down. They're at a price where commercial property is looking very attractive, particularly to other asset classes such as private credit and term deposits. The biggest mistake we see through different cycles, and I've been doing real estate now for almost 25 years, is that the retail market and even some of the wealth sector tend to wait and see multiple years of price growth and valuation growth before re-entering the market. The institutional investors tend to come in early, and they get those outsized returns simply by deploying earlier and having more confidence in where we're at in the sector. So for me, supply challenges, yes, that's going to continue. Population growth, regardless of which side of politics is in, is going to continue. It's very costly to build, and we think that the rental growth is going to continue up. And for those investors that look and have conviction, like we do, that enter the market now, we think they're going to be rewarded with outsized returns relative to the risk that they take on.
Okay, brilliant. Thanks, Steve, for sitting down with Livewire today and sharing your insights.
Thanks, Anna.
If you enjoyed that interview, give it a like and don't forget to subscribe to our YouTube channel. We release new content every week.